All right, let's dive in. Today we're going to try to unpack the latest U.S. economic news and figure out what's got the markets all riled up, especially all this buzz about the new NFP data.
Yep, NFT's definitely got everyone talking.
And to help us make sense of it all, we've got some awesome analysis from ACY and ING. So get ready for a wild ride through stocks, the dollar, the euro, and even a little peek at gold.
Buckle up.
By the end of this deep dive, you'll have a much better grasp on what it all means, especially for your own wallet. And trust me, things are getting kind of spicy out there. We've got the dollar on a tear, stocks looking a little shaky, and oh yeah, that little thing called a presidential inauguration just around the corner.
You know it. And what's really interesting is how these things, they might seem totally separate, but they're actually all tangled up together. Once you see those connections, you'll have a way better understanding of what's happening in the financial world right now.
Okay, so let's start with this NFP report. I keep hearing it mentioned, but I gotta admit, it kind of went over my head. What exactly is it, and why is everyone making such a big fuss about it?
So the NFP report, or non-farm payroll report, it basically tells us how many new jobs were added to the U.S. economy, outside of agriculture.
Okay.
And it's a really important indicator because it gives us a snapshot of how much spending power consumers have and, just the overall health of the economy.
Gotcha, so it's kind of like a pulse check for the economy.
Uh-huh.
But I heard this latest report was a bit of a bombshell. What was so surprising about it?
Well, ACY is reporting that a whopping 250,000 new jobs were added in December.
Whoa.
Way more than anyone expected. Plus, the unemployment rate dropped to 4.1%.
Wow, that's a pretty big drop. So on the surface, this sounds like awesome news. But I have a feeling there's got to be more to it, right? It can't be all sunshine and rainbows.
Yeah, you're right. This kind of points to a super tight job market, which usually leads to higher wages, right? People have more money to spend.
Yeah, makes sense.
But here's the catch. That can actually fuel inflation. More money sloshing around means more demand for stuff. And when demand goes up, well, so do prices.
Ah, so it's kind of like a double-edged sword. Good news for workers, but maybe not so great for our wallets at the grocery store.
Exactly.
And ACY mentioned something about the market reacting to this with a bit of a, I think they said a wobble. What exactly happened?
Yeah, there was definitely some uncertainty in the markets. The stocks got a bit jittery, and as you might expect, the dollar jumped up.
Speaking of the dollar, it seems like it's been on this crazy upward climb lately. It's almost like nothing can stop it. What's driving this crazy run, and who's kind of getting trampled under its wheels?
Well, as the ACY report points out, one of the big factors behind the dollar's strength is rising 10-year Treasury yields. They've actually climbed above 4.7%.
Okay, and that's having a ripple effect on other currency.
Big time. The pound, for example, is really struggling. It's even broken through key support levels.
Well, that doesn't sound good.
And it's not just the pound. The euro and the Aussie dollar are also on a downward slide.
Following the same pattern.
Yeah, and ING's analysis actually pointed out a specific risk premium of 2.5 to 3% for the euro against the dollar.
Wait, risk premium, what exactly does that mean? Like, how does that translate into the real world?
So a risk premium basically means investors see a certain investment as riskier than others, so they demand a higher return to make up for that risk. In this case, the euro is seen as riskier compared to the dollar, so investors are basically saying, okay, if we're going to hold euros, we need a bigger potential payoff, hence the extra 2.5 to 3%.
Gotcha. So it's all about how the market perceives risk. But for those of us who aren't, playing the currency market every day, why should we care about these ups and downs? How does it affect us in our daily lives?
Great question. A strong dollar can make traveling abroad more expensive, for one thing. When you exchange your dollars for, say, euros, you'll get less of those euros now that the dollar's so strong.
Right. Less bang for your buck.
Exactly. And it can also impact the price of imported goods. Everything from electronics to clothes could get more expensive because those imports are priced in, well, you guessed it, dollars.
Ah, so it's not just abstract numbers on a screen.
Yeah.
It directly affects what we pay for things. Okay, so we've got a strong dollar, a booming job market. On the surface, things seem pretty good. But you mentioned stocks might be starting to show some cracks. Are we really headed for a stock market cliff? Should we all be panicking and hiding our money under the mattress?
Well, that's the big question everyone's asking right now. ACY is pointing out a kind of worrying pattern in both the S&P 500 and the NASDAQ. They're both showing a pattern of lower tops and bottoms, which could be a sign of trouble brewing.
Okay, I have to admit, I'm not super familiar with that kind of market analysis. What exactly does lower tops and bottoms indicate? And why is it causing so much concern?
Imagine you're looking at a chart of stock prices over time,
Oh,
right?
okay, got it.
If you see a series of peaks and valleys, but each peak is lower than the one before it, and each valley is lower too, that's what we call lower tops and bottoms.
Oh, nice.
And this pattern often suggests the market might be overvalued, like the prices are inflated, maybe a bit too high compared to what the companies are actually worth.
Overvalued, that sounds kind of ominous. Can you break that down for me? Like, for someone who's not a Wall Street whiz, what does that mean for everyday investors?
Well, simply put, it means stock prices might be higher than they should be. There could be all sorts of reasons for this, from, investor hype and speculation to broader economic factors. And when a market becomes overvalued, it's more prone to sudden drops, or what we call corrections.
So it's like a bubble waiting to burst.
That's one way to think about it.
Yeah, okay. That's a little unsettling. And how does this strong NFP data, which seemed like good news, tie into all of this stock market unease? I thought more jobs meant a healthier economy, which should mean a stronger stock market.
It's a bit counterintuitive, I know. But in this case, those strong employment figures are actually fueling worries about inflation. Remember how we talked about increased consumer spending pushing prices up?
Hmm.
Well, that's making investors a bit nervous.
So it's a delicate balance. A strong economy is generally good, but too much growth can lead to inflation, and then the markets freak out. It's a bit of a head-scratcher, isn't it? But hold on. Before we completely spiral into a black hole of financial anxieties, ACY mentioned something about gold. They said it's inching towards the upper end of its range. Is this like a beacon of hope in all this chaos, or just a fleeting glimmer?
Ah, good old gold. It's always an interesting one, isn't it? Gold has always been seen as a safe haven asset, especially during times of economic uncertainty or when inflation is a concern.
So when investors start to get nervous about traditional markets, like stocks, they turn to gold to protect their wealth.
Exactly. It's like a flight to safety. They seek out assets that seem more stable, less likely to be affected by wild market swings.
So we've got this interesting push and pull happening. The dollar's soaring, pushing other currencies down, but gold seems to be holding its own.
Right. It's like a tug of war between these different forces. On one hand, a strong dollar tends to put downward pressure on gold prices because gold is priced in dollars.
Makes sense.
But on the other hand, gold's appeal as a hedge against inflation gets even stronger when inflation worries are running high.
And right now, those worries are definitely running high. So it's like a battle between a superhero and a supervillain, each with their own unique powers. But it seems like all these different storylines keep circling back to this one central theme: inflation. Is that the real puppet master pulling all the strings?
You got it. Inflation is the key that connects all these seemingly separate events. The strong NFP data, with its hint of continued consumer spending growth, suggests that inflationary pressures are likely to stick around.
And ING really hammered that point home, didn't they? They called inflation a headache and emphasized how the markets are already factoring in inflationary policies.
They did. And that's a crucial point. The market's always trying to predict the future, and right now it's pricing in the expectation that the Federal Reserve will have to keep interest rates high to combat inflation. So those hopes for rate cuts that some people were banking on, yeah, those are fading fast.
So it's like a constant game of chess, with
Yeah.
everyone trying to anticipate the next move. And just when you think you've figured it out, something new comes along to shake things up. Speaking of shaking things up, ING also brought up a pretty significant wild card.
Hmm?
A certain someone's inauguration is just around the corner.
Oh, yeah, that.
They specifically mentioned President Trump's inauguration and the potential for some day one measures that could really throw a wrench into the works.
It's true. Whenever we have a big political transition, especially one that could bring major policy changes, it injects a dose of uncertainty into the economic outlook. Markets hate surprises, so they'll be glued to what President Trump's administration does in those early days.
And ING even delved into the potential role of Scott Bessent, the Treasury Secretary nominee. They highlighted his focus on fiscal responsibility. Could he be a voice of moderation, a counterbalance to some of President Trump's more bold economic ideas?
That's a good question.
Only time will tell, I guess. But one thing's for sure, things are about to get even more interesting.
Absolutely. It's going to be fascinating to see how it all plays out.
All right, before we get swept up in the tidal wave of upcoming events, let's take a step back and reflect. After this whirlwind tour of the economic landscape, what's your overall take on the situation? Are you feeling optimistic or a bit more cautious?
Well, that's the million-dollar question, isn't it? Honestly, there's no easy answer. There are so many moving parts right now, and the situation's evolving rapidly. The NFP data paints a picture of a healthy, growing economy, but the shadow of inflation looms large, and the political landscape adds a whole other layer of unpredictability.
So it's not just about trying to make perfect predictions or time the market perfectly. It's about staying informed, understanding the forces at play, and being flexible enough to adapt as things unfold.
Exactly. We're in a period of rapid change and heightened volatility. The best approach is to stay vigilant, diversify your investments, and most importantly, don't panic. Stay calm, focus on the long-term fundamentals, and we'll navigate this together. It's like trying to, put a puzzle together, but the pieces keep changing shape right in front of you.
But that's what keeps things interesting, right? Keeps you on your toes, makes you think.
Definitely. It really shows how important it is to, stay curious, stay informed, and be ready to adapt. The financial world's always changing, and if you want to stay ahead, you got to be able to roll with those punches.
Couldn't agree more. Knowledge is key, especially in a fast-paced environment like this.
So for our listeners who are, maybe feeling a little bit of both intrigue and anxiety right now, what's the one piece of advice you'd give them as they try to digest all this information? I'd say don't let yourself get overwhelmed by all the data. Focus on understanding the big ideas, things like, inflation, interest rates, and market sentiment, and how they all connect with each other.
Right.
Remember, these things don't happen in a vacuum. The U.S. economy is part of a much bigger global system, and what happens here can have ripple effects all over the world.
It's all connected, like that
Yeah,
butterfly flapping its wings and causing a hurricane on the other side of the planet, right?
exactly. And that just goes to show how important it is to understand those global connections. What happens in one market can set off a chain reaction in others, creating both opportunities and risks.
Speaking of excitement and a little bit of the unknown, who knows what twists and turns are waiting for us in the next few weeks and months, right? Maybe President Trump will pull a fast one with some unexpected policy move. Maybe inflation will chill out a bit and give us all a break. Or maybe the stock market will do something totally crazy and shoot up even higher.
The possibilities are, well, endless. And that's what makes it so fascinating to watch and analyze. The key is to, stay involved, keep learning, and don't be afraid to ask questions. The more you understand about these complex systems, the better equipped you'll be to make smart decisions.
Well said. And with that, we'll leave you all to chew on all this and come to your own conclusions. Keep a close eye on those markets, stay curious, and remember, the world of finance is a never-ending adventure. We'll see you next time.
It really is a bit of a puzzle, isn't it? But, the pieces keep changing shape right in front of you. Makes it interesting, though, right? Keeps you on your toes.
Yeah, for sure. And it really emphasizes how crucial it is to stay curious, stay informed, and just be ready to roll with the punches. This world of finance, it's a fast-moving train, and if you want to stay on board, you got to be adaptable.
Absolutely. Knowledge is power, especially in a dynamic environment like this.
So for our listeners who might be feeling, I don't know, maybe a mix of intrigue and a little anxiety after all this, what's the one key takeaway you would want them to walk away with?
I'd say don't get bogged down by, all the data and the numbers. Just try to focus on the core concepts: inflation, interest rates, things like market sentiment, and how they all connect with each other.
Right, yeah.
These events, they're not happening in a vacuum. The U.S. economy is, part of a much larger global system, and decisions made here have a ripple effect, impacting markets worldwide.
It's all connected, right? It's like that butterfly effect, isn't it?
That's a good way to put it. And it just highlights how crucial it is to understand those global connections. What happens in one market can trigger a domino effect across others that creates both opportunities and risks.
Right, definitely. So as we look ahead, who knows what's in store? President Trump might, I don't know, surprise us with some unexpected policy move.
He might.
Maybe inflation will finally cool down, give us all a breather, or maybe the stock market will just, defy all expectations and just skyrocket.
Anything's possible. And that's what makes it so exciting, to watch and analyze. The key is to stay engaged, keep learning, and don't hesitate to ask questions. The more you understand, the better equipped you'll be to navigate these financial waters.
Well said. And on that note, we'll leave our listeners to ponder all this, come to their own conclusions, keep a close eye on those markets, stay curious, and remember, the world of finance, it's a never-ending journey of discovery. Until next time.